Welcome back to the Personal Finance Project. Today, Scott and I are going to approach the topic of gold. I'm sure a huge majority of the listeners, as well as pretty much everyone in this room, we've all heard the ads for gold. So converting your IRA or your qualifying 401k into a IRA or 401k backed by physical gold. And it is often regarded and pitched particularly strongly to retirees about on the basis of it being a safe haven or a hedge or just a place that I think somewhat unfairly in the ad makes it seem as though it is a risk-free way for you to store your wealth.
Yeah, I would say that the volatility of gold is very much downplayed in those types of ads. And a lot of times the volatility is something that people enjoy, frankly. If you've owned gold for the last few years, it's been really volatile, but it's mostly been going up.
Yeah.
So there may be a period coming up where it looks, even worse than you might expect it to, because the volatility has kind of been working in our favor for 3-4 years now. Maybe we get a period where it stays volatile but is plateauing, and so therefore it feels even worse. So I would agree with you. There's several challenges with investing in gold, and one of the ones that you bring up frequently is that it is kind of a zero-sum trade in that you can't reinvest your gold dividends to buy more gold. It doesn't do that.
No.
And at some point, if you really want to make money off of it, you have to sell it.
Yeah.
It's one of the only assets that you can't really accumulate more of through ownership.
Yeah. If you were to buy a 3-ounce bar of gold, put it in a safe that you also purchased, insured it, closed that safe, came back 20 years later and opened it, you would find in that safe a 3-ounce bar of gold. It would not have paid you a dividend or a coupon over the course of its life. It would not have grown more bars of gold as a consequence of sitting in your safe. It would not have created a business or started selling products. It would literally just continue to be a 3-ounce bar of gold. And over that time, sure, the price at which you could have sold it to another buyer would have gone up. In some instances, it would have gone down. But you wouldn't have been able to take an income stream from that bar of gold at any given time. Now, some people out there might say, well, it's kind of a unfair characterization because there are certain things you could do if you owned a bar of gold. You could certainly maybe use it as collateral and get a loan.
You could borrow against it.
You could borrow against it. That's true. But I think the primary argument against gold that Warren Buffett would make is it's not an operating company. And I think his famous quip was, I would much rather own a goose that continues to lay eggs than just to have one of the golden eggs.
Yeah.
And I think that that's a fair point. And I think that especially when they're pitching these things to retirees, that's where I come down and saying, and this is something you point out to our clients all the time, when we point in their annual review to what the cash flow has been off of the portfolio, and you say to a certain extent, the cash flows are somewhat unrelated to the volatility of the underlying assets. And that's been true for most of the dividend-paying stocks that we have our clients in, old world, very well-established companies is, as we noted during COVID, a lot of those have lost a lot of market value, but they continue to pay their dividend. And so that, for me, is important for a retiree who isn't necessarily too preoccupied, although certainly somewhat preoccupied, with the value of their portfolio, but more of, well, what will it pay me to own it every year? And some of them are perfectly sanguine to know, oh, it's great. My income needs are covered because I can clip the coupons and take the dividends. I don't have to invade the principal. Not something you could do with gold.
Yeah, and that's one of the things that we talk about frequently, in that the closest you can get, and there's always inflation and complete black swan events that out there that could contribute. But
sure,
the closest you can get in financial planning to bulletproof is having your investments produce what you need to live off of in cash.
Yeah.
And so that you don't have to sell anything. And gold will never really fit in that strategy because it's not going to pay you.
No.
And you can't do a gold redemption plan where you get an
annuity, a tiny little piece of your gold,
chipping off little edges of it.
And then, so in principle, as an asset in a retiree's portfolio, we're against it for those reasons. But then, even in the broader reason, when you're talking about an accumulator, you have people say, "Well, I own gold because I think it will appreciate rapidly, and maybe 30 years from now, I'll take my gold and I'll turn it more back into U.S. dollars, and I'll be able to buy goods and services with it at that time." And it's like, all right, well then, a close examination of the history of how gold has performed over a very long period of time, say something like 30 years, you will have dutifully lagged broader equity markets by probably 400 to 500 basis points per year. And it's like, if you compound that over time, you are falling so far behind that this, as an investment in the way that you and I would regard it for a person in their accumulation phase, is marginally better than what you would be getting on maybe an inflation protected government security or something of that variety.
Yeah, and I would. This is an idea that just popped into my head. So let's, if it's terrible, just let me know. But you could almost think of gold in a way, like if you say you don't really want to think of it as an equity investment because it's not an operating company,
right?
Say you want to try to think of it more as a bond. Well, if you wanted to think of it as a bond, it's a zero coupon bond with a very long duration because you're probably never going to sell it. At least that's our experience with a lot of people. They buy some gold and then they hold it for a very long time. So there's your long duration. And the zero coupon, we're basically just hoping we bought it at 60 cents on the dollar, and we can turn it in for $1 at some point in the future.
Yeah. No, I think that's an adequate way to describe how people generally buy gold. But the other one is they say, all right, Greg and Scott, I hear you. It hasn't kept up with the equity markets, and it's been marginally better on inflation-adjusted terms than Treasury bills has been long-term. And the delta is not that big, really. And Treasury bills are guaranteed, whereas gold absolutely not guaranteed, as you mentioned with the volatility. Saying,
for those who are just tuning in, it's a rock.
Exactly. It's basically, as Richard would like to say, no different than a pile of gravel. So
it's shinier.
It's very shiny. But they will say, whoa, what about this? Embedded in this gold, you can't see it, you can't taste it, touch it, smell it. However, there's this unique characteristic that says when market conditions are just so, it's going to go to the moon. And we're like, go on. And they say, well, then I'll have, for a brief period, a very valuable asset in my portfolio. Go on. And they say, well, what do you mean? Think, well, okay, if, like you mentioned, gold can be thought of as a zero coupon bond, 100% of your return will only be recouped if you sell the daggum thing and actually turn it into spendable cash. And as we were just talking with a client the other day, you know how many people have executed on that with perfect fidelity? 0. And that's the difficulty, is when gold would be best to sell, right when you would want to part with it, what would be going on in the broader economy? It'd be probably pretty bad. If gold is the winning asset of the day, things are not going very well in the economy. And how inclined would you be to sell your, literally in this case, shining star of an asset right at the point of maximal pain?
So this is kind of what I was saying, was that every asset has windows where you either feel great about selling it, you feel okay about selling it, or it's terrible. And you're going to feel really, really poorly about selling it. I would say that stocks, about 50% of the time, you feel really good. Maybe another 40% of the time, you feel pretty good. 10% of the time, oh my gosh, this is a terrible decision. Don't do this. Bonds are probably just a little bit less dramatic because they don't vary in price that much.
People tend to feel really bad about bonds when equity markets have done very well.
Yes.
Yeah.
So, but I guess what I would say with gold is it has tighter windows when you feel good about exiting, if you look historically, because it has these periods like the last couple of years where it does really, really well for a couple of years, and then it can go into the doldrums and do almost nothing or go down over a 15, 20-year period where stocks don't really do that. So that could be a long, long timeline where selling your gold feels like you've put yourself way behind, as opposed to even feeling like you did okay or broke even.
Yeah, because I think from our perspective, if it's part of a portfolio, really the value would be in, I've held this asset, it has an unusual characteristic or quality such that it has performed really nicely when my other assets have not performed well, and now I can sell the overvalued asset and buy the undervalued asset. That is, in principle, is great. Like if you can execute that with perfect fidelity or with great accuracy, very difficult to accomplish, then sure, own as much gold as you'd like. But most people don't do it that way. In fact, most people do the opposite, where we've gone through a bit of a rough period in the markets and inflation has taken off and gold is starting to appreciate rapidly. And then all of a sudden they think, well, you know what? We should buy some gold.
We should get some of that.
Yeah. And this was a point that producers Hannah and Kier brought up, saying, well, what about the true believers? Like, what about the people who think we're going to be in a Mad Max style post-apocalyptic world where we're actually going to be exchanging gold for goods and services in the future? And I think this is the point that you've raised with many clients is, where is the gold right now? Like, where is it? It's not in your, unless you literally have some in your safe, you don't really have ready access to it.
Yeah, and that's where, so if you either say go the ETF route or the physical bullion route, unless you, like you just said, you have a very, very large safe. If we're really talking about a lot of money here, you're not going to have it in your house. It's not going to be there for that true emergency scenario.
And then in the event that, say, we have this Mad Max, how is it that we agree on the value of the gold? So saying none of the markets are working. So there's no efficient market for gold. There's no spot price for gold. There's no future price for gold. There's just whatever it is that your neighbor is willing to exchange for the gold coins that you have. In exchange for what? Like, he's going to thatch your roof? I don't know. It's certainly possible. But I think this notion that the value of gold will follow into this sort of scenario such that we will have a readily agreed upon price at which we are willing to exchange it, I'm not convinced that that's going to be true. I think that it would be very difficult for people to decide on what exactly an ounce of gold would be worth under those kinds of extreme conditions.
Yeah, it seems more likely to me it would be, that guy's got some gold, let's go take it from him.
Well, yeah, there wouldn't really be anything to stop people from doing that because it's hard to transport. It's really difficult to store, hard to protect, because when clients bring this post-apocalyptic scenario up as a justification for an interest in gold, I tell them, look, if I were really worried about that eventuality, I wouldn't want to be long gold in that scenario. I would want to be long assault rifles and canned goods, and I think that that's probably a better way.
Property in the middle of nowhere.
Yeah, or property in the middle of nowhere of a store of value than some gold coins you might hopefully exchange for some watermelons at some point in the future.
Yeah.
But if we bring ourselves back to the modern era and we talk about the various ways in which people own gold, I think that this is an important distinction to make for people because they're often confused by physical gold ownership, owning stocks of mining companies, or owning ETFs that are backed by gold. And so those will have different, and then owning futures. So if you speculate in gold, if you own physical gold or ETFs that are backed by gold in a taxable account, so this would be an account, maybe you think it's a great idea to own it there because, as you pointed out, it's a zero yield asset. So you say, well, I just get all the appreciation on it, and then when I sell it, I get preferential rates. Not true, because the United States government views that as a collectible. And so if you own a collectible, even if you own the ETF, and this is very confusing for people, if you own an ETF backed by gold, it is considered a collectible, even if it is being traded on an exchange. And so if you hold it for 1 year plus 1 day and you sell it thinking you might pay 0 or 15%, you're wrong. You're going to pay your ordinary income tax rate up until a cap of 28%. And that can be a big surprising tax bill for people who have a big appreciated position in gold and then exit it thinking they're going to get preferential rates. You do not.
It's funny that 28% bracket literally doesn't exist except for that
collectibles.
Now. Yeah, except for collectibles now.
And how arbitrary, too. Even back then, we're like, you know what? 28%, that seems about fair.
Yeah.
But that could take a real bite out of any appreciation you had in gold.
Well, and I think that's why the gold IRA idea, one, it has gotten really popular. One, because IRAs just have a lot more money than they did 20 years ago. 20 years ago, a couple $100,000 in an IRA was a massive amount of money. Now we see $1 million IRAs plus.
Yeah.
So I think that is one of the reasons the gold IRA has gotten popular, because that 28% collectible rate is just really unattractive.
Yeah, and it shelters you from this sort of like, oh yeah, there is an embedded tax liability that you cannot escape even if you hold it for 1 year plus 1 day. So it's a way to, again, say, well, we're not really telling you the whole truth, and we're going to say own this in a tax-sheltered account, which what they mean by that is just a typical IRA or 401k, so that you never encounter this problem that is, kind of indelibly linked to gold ownership. Which I think is a bit underhanded, admittedly, because not everybody has access to a big IRA or 401k,
I would agree with you. I mean, I am a big kind of proponent of feeling like most financial advertisements are pretty bad.
We have a whole segment on it. Yeah.
Deceptive and just not something I would put my name behind.
Yeah. And incomplete. The other thing that you could do is you could own the stock of gold mining companies.
Yeah. So, and that is a route where you could get around our first kind of argument against, which is, I don't follow them very closely, but some gold miners will pay a dividend.
Yeah.
So therefore, you've got a stream of cash flows from the operating business, and you potentially have a dividend that they're paying as well.
And you could argue those companies will do well as the product they are mining and selling does well. So price of gold goes up. You would expect, though this hasn't been true all the time, that the operating companies in the business of extracting the gold are going to go up at about the same rate or roughly at the same time that the gold itself is going up. I think it's a fair argument, and I think some people own gold mining stocks probably incidentally, but some people will seek them out. And then you do get preferential long-term capital gain treatment. If you buy a stock in an operating company that is mining gold, sell it after 1 year plus 1 day, then you can qualify for the 0, the 15, and the 20%.
Yeah, and I think the issue that people run into on that one is maybe it kind of runs a counter to some of the other ideas that you may ascribe to if you want to buy some gold. One being that a lot of gold miners, just because of the distribution of this particular element in the world, are not domiciled in the U.S. So you want to own gold as maybe a backup to the dollar, but you want a company with big exposures to, like, the Democratic Republic of Congo,
right,
or the Gambia or someplace like that you might not actually really want to own companies.
Exactly. Yeah. So there's still a lot of reasons that you wouldn't necessarily want to own gold directly through a mining company. However, on the tax point, you could save it. But same thing. I think if we look at this and we scrutinize it even with just a little bit of rigor, you discover gold mining companies have not kept up with broader market indices like ever. I mean, there are certainly periods of time over which they will outperform. We're absolutely saying that has been true of gold. It's been true of mining companies. But you could make that argument in favor of pretty much any other asset class. Is there going to be times that they outperform other asset classes? But it seems as though gold has this special place in many people's hearts, that it has some characteristic or property to it that makes it where they don't want to do this analysis. They don't want to do the opportunity cost analysis of, I don't really question what I could have owned instead of the gold. I'm just glad that I own the gold. And I think that is at best incomplete. And at worst, it's going to put you in a position where you're much worse off financially than you otherwise could have been, even if gold does have a run up like we've seen.
Yeah. And I would say also it has a lot of aspects of over concentrated single stock exposure, where you're living and dying by what this one thing is doing.
Yeah.
Where if you own the S&P or the Dow or the NASDAQ, there's a whole lot of different things that can change and improve your fortunes.
Yeah.
As where gold, it's moving, it's one thing. It's that same rock from before.
Yeah. And producer Hannah has this thing where if we go to the grocery store and there's only one item left of a specific thing that she was hoping to get, she's like, ooh, this is a really good indication that I should be buying this product because there's so few left in stock, which would say the broader market is buying up this product. So she's using that intuitively of saying, this must be popular and I'm making a good decision. And that's why I think parting with your gold is so difficult, is because your gold has run up. And if gold runs up, it is a finite asset governed strictly by the laws of supply and demand. That's it. Just like any other finite asset, pork bellies, gravel, gold, they all share similar characteristics in that as demand for these products is rising, the price of these products is going to rise. So you can imagine you're taking your pork belly or your gold and you're going to sell it, but everybody else is buying it. There's nothing left on the shelf. Are you really going to feel good about that transaction? Or are you going to think, maybe the crowd knows a little bit more than I do about this transaction, and am I about to make a very, very painful mistake? So I think that's another sort of behavioral side where it's like, you're not going to be getting good clues from the market as to when it is that you should be parting with that asset. And in fact, you're probably going to be having the opposite screamed in your ear while you're trying to accomplish this.
Probably. And I think as just a final thought, we've talked about this a little bit, that we've kind of reached this stage in, I don't know if it's the economic cycle or just the place where we are in terms of like looking for investment potential, is we've kind of reached the capitalization of everything, where it's like, all right, I've got an ice cream stand that my daughter tends to on the corner, a lemonade stand. Right. It makes a lot more sense. So I'm going to put a 15 multiple on that and buy it from you. So we're kind of at a stage where people are really, really kind of looking and at their wits' end for profitability and good asset classes. Is now, when you're getting a lot of advertisements about gold, is it a good time to be jumping in, or should we think about that as the 15 times multiples lemonade stand.
Yeah.
I might think of it more like the latter.
Right. Is this the clue that maybe this asset class, if they have to advertise it so aggressively, if they have to twist my arm into buying it, is it really a product worth buying? So if my kids launch a lemonade stand, though, we'll sell it to you for 15x multiple for sure.
At 12 is the most I'm willing to pay.
We'll haggle about that some other time. Let's also get into the bit of where I think as a theoretical construct, and with the ability to own ETFs that are readily available on an exchange, people forget that there are physical costs with the actual ownership of physical gold. And so you got to buy it. Obviously, step one, that would be your basis in the gold. And now a lot of people might think, well, I had to buy a safe to put it in. And then I needed to insure it just in case something were to happen, and it would be to damage, stolen, lost, whatever. So I insure it. And then I got to transport it from time to time. Like if I wanted to sell it or if we moved or whatever, and that costs money. And so they might come to us and say, well, can I capitalize those costs, those ongoing maintenance costs of my gold into my basis? And the answer would be no. The IRS does not allow you to capitalize those ongoing costs associated with the gold into the basis of the gold. You can't add it. Now, costs that are specific to the transaction, so if you were actually going to go sell it, you can add to your basis. So this would be something where you took it to a qualified dealer. And so just finding a person with whom you felt like you could trust is going to give you the actual spot rate of the gold. They might pay a premium for it in some cases or a discount in some cases. Got to find that guy or gal. Got to trust them. The other part would be getting your gold there. And then once you have the gold there, they have to assess how pure it is.
Mm-hmm.
And that costs money and takes time. And so it's like, and gold is very volatile, as you mentioned. So occasionally you can get a spot rate and they can have it good for a certain period length of time while they're doing all of this stuff. But I think people maybe underweight how contrived or difficult it might be to actually get their physical gold from point A to point B, find a person that is willing to buy it at roughly the market price of gold, and then actually get the dollars extracted from that deal. And then they're not going to issue a 1099.
Yeah. And I think the whole, what you're really getting into here is if you want the convenience, and I'm using air quotes here for those listening, and as opposed to watching the video,
right?
If you want convenience or an accessibility, you're going to pay for it.
Yeah.
So if you want to have access to the money, you're going to pay for it in insurance and storage costs and transaction costs and all these things. As where if you go the ETF route, as an example, you're not going to pay for those things, or very, very,
very few
minute participation in the storage of the gold on an ETF.
It's baked into the price of the ETF.
Yeah, it's baked into the price, but then you don't have access.
Exactly.
So it's you're going to get one, but not both.
Yeah,
on,
and I
on
think,
the side of the.
And then I think that brings us back to like this notion, and this has been popular in some personal finance books, that without much rationale, they just say portfolio should have a permanent position 2 to 5% gold. And they're never taken to task on why a portfolio should have a perpetual allocation to gold. You know what I mean? Because for me and for you, if we're talking about a client with a perpetual allocation to some asset class, either it has some deep embedded personal value. So you inherited a stock from your grandfather and you're just going to keep passing this thing down generation to generation. Like, okay, you have a perpetual position there. Or you have a perpetuity, like in the financial parlance, that's going to be paying you an income stream. Because I think if I'm going to have any asset in my portfolio forever, I want it to pay me cash for the duration of my ownership.
Or the other option is you've decided it's a perpetual investment because you've come to the point where you realize, oh, you know what? I can't spend all this money. Somebody else is going to get this asset.
Right.
If that's where you are, gold also is not the best fit because as you established, it has not kept up with the market over long swaths of time historically.
And I think I made this note to myself when I was reading up on like basic underlying investor philosophy on owning gold, is it's kind of like they put it in their portfolio because they know storms are on the horizon. They don't know how far off they are and how intense they might be, but they know, hey, we're going to go through a contraction. Like I think it would be foolish to think my entire retirement or my entire career never going to see an economic slowdown. You're going to be sorely disappointed, but they put it in their portfolio knowing these things are out there. And then when the storm comes, they go and they look at their gold and they go, nice. And that's it. And that's the whole value is saying, well, my bonds are kind of doing crap like in 2022. My stocks are really in the toilet, but look at it. Nice.
I showed them.
Yeah. And that's it. And it's like, I think from our perspective, we see that. And I guess if it keeps people on, as Justin was saying, if it keeps people in the fairway and it prevents them from going totally out of their plan, reasonable conversation.
Yeah. And I think if you really think that you have some insight into gold that Greg and I don't, then as we talked about in, I think the podcast with Mike Antonelli, if you want to have that 10% kind of play sleeve, that's probably where I'd own this.
Yeah, like if you're a speculator, I think gold is a wonderful asset to speculate in, minus its sort of unfortunate tax obligations. So if you have it in the IRA, not a great account to be speculating in because that's principally to serve you in your retirement. But setting all that aside, because I don't think people who are speculating in their portfolios much care about the tax consequences, though they should, I view gold in the way that probably a lot of people would view their house, which is I kind of like it. It don't really move around in value that much. I don't really think about its value that much until the point of sale. And then it feels like I made a lot of money because I've ignored all of the associated costs that went into the house, like gutters and roof replacement and all these other things that you can't deduct because you're not operating a business and that don't meet the threshold for like a capital improvement or whatever. But their costs all the same, and that's money going out of your pocket. It's like the insurance or storage costs of gold. So if people really do view it in that context and it just makes them feel good, that's fine. But I think part of the reason you and I are employed is we try to help people make incrementally better decisions with their money. And so that was a whole episode we did on the house, was saying, yeah, it really feels like a great investment because, and even Antonelli said this, is the best investment people have owned is their home. I think what he meant by that is the investment they feel the best about has been their home. And that's because you and I both do this. You're in the process of maybe selling a home. It's like you just remember what you put in a big lump sum. And then you're going to get this big number that you're going to get out and your brain is going to go, wow, great investment. You're not going to do the calculus. You're not going to do, okay, well, what was my compounded annual rate of growth over that period of time? So you're not going to do that. I didn't do that.
It's all simple rates of return.
Yeah.
When you get this long.
Exactly. And when you're talking about big chunky numbers where your house hasn't been paying you a house dividend, I guess it's been paying you imputed rent over that period of time, but nobody ever thinks about it that way. And no one ever thinks about gold that way. No one ever thinks about, wow, had I just put this in bonds, I would have gotten these cash flows over this time. And as long as the context is right, and as long as they're not relying on this asset to do something that it just patently can't do, I think you and I come down on the side of you could do better, but you could do worse.
I agree. I think you could do worse. So as a final thought, I don't think we ever got the report, is the gold actually in Fort Knox?
I don't know.
Come on, Craig.
Did we touch on everything we wanted to touch on? All right. Well, that was another Financial Mythbusters segment, if we're going to call it that today, although I don't necessarily think there was any one myth that we really wanted to go after. Because like we said, go ahead.
Oh, I was just going to say next week we're going to do silver and platinum. It's going to be a multi-part.
We're going to cover all of the precious metals. Although we could probably do. There's a lot of parallels to crypto, so we could be setting ourselves up to do something similar with crypto. But anyway, wherever you're listening or watching this podcast, please like and subscribe.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.